time that we minimize tracking error. And we wanted to know, should the portfolio be 100% Bay Area? Or should we be willing to loosen that up for the sake of getting better tracking error, which is part of our fiduciary duty? And so we wanted to check out, how far did we have to look? You know, there's your trade-off right there. The alignment with your mission, the tighter and tighter you get aligned with your mission, you might have more impact, but you're quite likely, and we found out, you will be increasing your tracking error as well. So how do you balance those things, tracking error with mission alignment? And we ran a bunch of different portfolios with Aperio. It's a portfolio management company in Sausalito that makes custom portfolios benchmarked against whatever index you want and whatever criteria. So they went through and they ranked. You can see the Russell 3000 starts out with a 46 score by our ranking system. And interestingly enough, the Bay Area companies already make up 19% of the Russell 3000. You know, I didn't know that. That's pretty decent. And I found in my research that similarly, the Bay Area is the 19th largest economy in the world. We are huge, we are diverse, and we are very innovative and fast-growing and employing a lot of people. So we ended up with 100% Bay Area only headquartered companies, 75% headquartered, and 25% other. And the other would be for diversification purposes, for the most part, as well as trying to continually improve the social score. And we took a low portfolio of 51, at least it had to be better than this one for the Russell. So 51 and we to 65, got a portfolio that could rank 65. Then we did the 75% and we said, okay, let's get 3 rankings, a low, a middle, and a high and a middle. And then if it was only half, what would happen if they, at a 49 and 65, and we said, okay, 50%, what's the tracking error? And you can see the tracking error along this line. We were trying to keep it really low, under 2%. So clearly a 100% portfolio was running a little high. So how did that look when we graphed it? Look like this. And so you can see as you increase your custom ESG score, you are increasing your tracking error. And as you increase your concentration of Bay Area companies, you increase your tracking error. And this is why everyone says you can't do it, because you're going to have too much risk. Well, not if you optimize and you're careful about these things. I think we can build portfolios that have both a small tracking error and an improvement in the kind of factors that we're seeking in our portfolio companies. So with this portfolio, moderately improved, I mean that's actually a 30% from here all the way up to here. You know, we get a big improvement in the ESG score and we contain the tracking error. So we know that with less than 2% tracking error, we'll end up meeting our fiduciary duty.
So just a question, Lauren. So when you're talking about tracking error, this is historical risk?
Yes.
Right. So the focus on this is take what we know about historical risk and apply it to the future. Mm-hmm. It's not necessarily future risk.
It's not. What we're hoping is that the ESG scores are going to be identifying the management of companies who are doing it well and disclosing it, so that we end up tilting the portfolio to those companies who have exhibited at least some better characteristics on E, S, and G. And those will all kind of just be muddled through the number system.
So, and I'm correct in your assumption that tracking area equals higher risk, because that's what I heard you say, and I don't believe that's the case.
No,
right?
I don't either. However,
who does?
Most of the institutional investment community, they think risk means standard deviation, and I got the same standard deviation, you know.
But I'm saying if the market is standard deviation is pretty high and the tracking area is not in correlation with the market, it does not necessarily mean that it's more risky.
Yes.
It just means that it's not in correlation.
I am arguing this with my trustees because I also think you could have a huge discussion on whether or not the benchmark is the right thing we should be talking about.
Right.
Do the benchmarks themselves make any sense? And why are we trying to track those? However, In the early stages of finance here, in the early stages of understanding impact investing,
He's figured it out, just have him.
I haven't figured it out, but these are the right questions.
Okay.
These are the right questions
Yeah.
among people who describe themselves as sophisticated investors. Is what is the risk or volatility? Is it historical or future? Are these asset investments correlated with each other or not correlated with each other? And so these are the right questions. And then what Lauren's running into, and some of us in the room are running into, is people can't see beyond the historical definition, and therefore can't see that the future probably isn't going to be the same as the past.
that's the next question. So that the ESG factors themselves by being integrated into the investment process hopefully will help us highlight companies that are better. But my fiduciary hat on, I know that I have to track those benchmarks. That is my job. If I am even if I outperform, people think that's risky. So when you're wearing your fiduciary hat, you've got your own assignment already. And so tracking error is the one thing that I can say, we have no more risk than the Russell 3000 with this portfolio, because we're within 2%. You know, that is a virtually negligible difference in risk. So it's going to be just as risky and is expected to get us just as good a return. That's what we can expect. We've done our fiduciary duty. Market rates, market returns.
So the tracking error depends on the asset class that you are investing on. So for example, if you are like Calvers, right, investing in private equity style, what's the benchmark and what's the tracking error?
That can come later because we're at the United Way and we're still only dealing with stocks and bonds for the small endowment fund that we have. But that's the exact same question that I'm going to ask in 3 minutes. And so we get to this, that portfolio that was circled ended up, looking like this. The Bay Area Index plus 15 others, plus 25% other companies that the computer picks through its optimization process. And these are the numbers, 1.64 tracking error, we got a good score, 75% of the portfolio is headquartered in the Bay Area. So we felt pretty good about that. And it made me start to think about other asset classes. We did get a fixed income fund to complement this equity fund by, this was the equity performance. So this is a model portfolio, has not been adopted, but it's being tracked by Aperio. And since we started in January of 11, so this is just over 2.5 years, we're outperforming. So that's a good thing. I'm sure it's within the statistical variation of expectations. So you can't outperform too much because people then say you're taking on too much risk. If you underperform too much or have too much volatility, you run the risk of people abandoning the thing altogether. So for starters, we're all starter fiduciaries in this field. So you want to keep your bands pretty narrow so you don't give up too soon. The fixed income portfolio we found through Community Capital Management. It's an existing mutual fund, a couple of $1 billion now, and it was created for the Community Reinvestment Act investors, and through that process they can earmark bonds within their nearly $2 billion portfolio. And for our investment of $800,000 into this large fund, we were able to get earmarked for bonds in the Bay Area, including Salvation Army bonds as a corporate bonds, and Ginnie Mae and Fannie Mae affordable housing bonds, small business administration bonds in the Bay Area. We felt that really aligned with our mission. It already existed, so that was a good solution for us. That part has been implemented. So that made me think, okay, if we can do this with stocks and bonds, let's talk about doing it for other asset classes that can have more impact. And then we could get the big guys in here, the pension plans, the community foundations, the private foundations. Why wouldn't they think about putting 1 or 2? If the Bay Area is already 19%, we can do 1 or 2% more intentionally in the Bay Area investing in different asset classes. And that is what we're going to start investigating now. So let me take a break. Any questions on the United Way research? Because it all evolved now into the Bay Area Impact Investing Initiative. So once we started talking about this, I thought, okay, we've done the right thing for the United Way and identified a small portfolio, a way you can do stocks and bonds very little impact. It's a nice little talking point. We can do corporate engagement. We can ask them not to pollute the bay, things like that. Give same-sex anti-discrimination policies, benefits. We can do that. We know that. But there's not a lot of real impact on alleviating poverty with this portfolio. But what could we do if we could convince other people to invest in the region for maybe not just poverty alleviation, what about broad economic prosperity and economic growth and development for everyone in the Bay Area to keep us strong? We're going to end up with our initiative that's going to tell us to educate the community, encourage public-private partnerships, and then find out how can we enable some investments. And we've been through these comments. We want to be proactive, intentional, under fiduciary standards, and create some solutions that we know are necessary in the Bay Area if we expect the Bay Area to remain top of the heap in innovation, science, diversity, tolerance, the things that we like. This was a new area for me. I've been in investments for a long time, but never in the community investment field. So it took a while for me to understand we can't just throw money at these community developers. They need to also match this senior capital with incentives. You know, they've got to have tax credits and other support systems and low interest rate loans before they can really line up. But we can help this by providing some liquidity and scale into this senior capital, into the community development financial institutions. At the same time, you know, which could be in a lot of these asset classes, CDFIs. So I began to think about, why don't we have a family of funds in different asset classes that could then reach different investors who have different risk and return and liquidity requirements and different impact expectations as well. We already know the United Way is only here and here. But I'm a trustee on the San Mateo County Employees Retirement System. We have $2.8 billion invested globally. We are here to serve the employees and beneficiaries of San Mateo County, and we put zero money into San Mateo County or the Bay Area intentionally. We already own, through our $1 billion in funds and stuff, we probably own some California bonds. We clearly own 19% of the Russell 3000 in the Bay Area. But we don't do any of that intentionally. And what could that do if we started putting money in each of these things and had each of these things focus on the Bay Area? Could we move the needle? And people often say, what's your impact? What's your impact? How many children are you going to save? Well, it depends on which asset class you're in. I'm not going to save any children, theoretically, with the equity fund, but we can change corporate behavior. You know, private equity, infrastructure, all of these things provide different impact, different liquidity, different rates of return, and different risk horizons. So, and these are still the kinds of impacts we could have within our own community if we chose to. What's the asset owners think about that? There's a lot of them. We have an enormous amount of money in the Bay Area. And I'm just thinking of the ones like, you know, all of the large school endowment funds, the community foundations we know are sitting on billions and billions, the pension plans, you can count up those guys just around the Bay Area, and the Hewletts and the Packards and the Omidyars and the Zuckerbergs. I mean, these guys made their money in the Bay Area. Maybe we could get them to invest 1 or 2 or 5 or 10% of their portfolios in the Bay Area. What if we got $1 billion? We could do something. So now we're going to start the Bay Area Impact Investing Initiative. This is a research and education effort. We are hopefully going to get some grant money to continue the research and build out some funds, if that's what the research indicates. In my mind, I can see these 5 funds, where an equity fund would influence and change corporate behavior around here, but we would expect market-like returns, much like we did for the United Way. And we could have a variety of managers in this fund of funds approach. An active manager like a HIP, I call our United Way screening process, sort of an enhanced index. And then we would definitely want to do some corporate activism and engagement with part of the portfolio or all of the portfolio. And I think that'd be a pretty good portfolio. Fixed income, same kind of things, but let's add more corporate bonds, I think. More infrastructure bonds. Should be some BART bonds in there, or BART bonds go into the infrastructure portfolio, or both. Mark?
Yeah, Lauren, are you thinking about doing it the way you've done with the United Way and having somebody sort of objective watch and model your original funds so that you're collecting data pretty quickly
Yeah.
before you're even collecting money?
Absolutely. We're gonna, we are creating some model portfolios right now of existing managers we know. We're gonna continue to do due diligence on the existing managers and new managers that we get to meet. And as we educate people, this is what we're watching, this is what we're thinking, would you be interested if we built it? And trying to see where that's gonna take us. And who would be interested in this? So we wanna do focus groups. We're gonna have a research survey. It'll be on our website as soon as we finish it, which hopefully in the next week or 10 days. And we're gonna take that to financial advisors at the CFA and Financial Women's Association. Presentation we're doing on September 25th. I'm talking to CalPERS public fund trustees at their roundtable on the 13th. We're gonna be at Net Impact, thank you, Paul, in late October. And anywhere else, people want us to speak or gather a focus group or at schools. So the other thing is, students, we would hope to challenge all of the universities in the Bay Area to create their own model portfolios for impacting the Bay Area. And let's get some press about this. Let's get some buzz going about what could we do if we wanted to invest here. I'll bet there's lots of little old ladies in the Bay Area that got a ton of money, and if they knew there was a way they could, they might put 10% of their funds back into these are investments. These aren't giving it away. You're gonna make a market rate of return or we can't do it. So we're gonna prove that and share that. And hopefully we get enough evidence that people want it, and then in 6 or 9 months, we'll start taking pledges and build some funds. I don't know what they're gonna look like. I would guess that it would be a stock mutual fund that could be tradable, and a bond mutual fund that would be tradable, so that the 401k employees at the United Way could put some money into something that aligns with their mission. The real estate fund and the private equity funds, real estate could be a Bay Area REIT. Hopefully it'll have sustainable and things like the HIP factors or somebody's factors, but buildings in the Bay Area that are located in places that there's job needs and things, so hire the locals, and you can find those, make a sustainable building and that sort of thing. Rehab seniors, we know that retirees can't live in the Bay Area, can't afford it. So let's have some more balanced housing. Let's put up transit-oriented development. So we're trying to develop right now investment policy statements for each of the funds. What would be the focus? How do we measure it? So again, we go back into what is the appropriate benchmark if we have to have one? Because some benchmarks are just screwy. Some are easy to beat, some are hard to beat, depends on their own cycles. But that's another definition about fiduciary duty. So we're gonna play that game for now. Infrastructure fund, love this asset class, very little opportunity to do it yet. But I think if we let people know that we've got a couple $100 million to invest in infrastructure, then things would come to us as well. But right here, BART bonds make a lot of sense to me in this space, and housing, and transit, other transit development. So how do we get that? We could get that partly by investing in things like the Bay Area Transportation-Oriented Development Fund, or the Low Income Investment Fund, and through CDFIs, some short-term loans to CDFIs that are doing that kind of investment might be what this portfolio starts with. And then later on, we get into some bigger projects, longer-term projects. Water, clearly, I'd love to be doing some water infrastructure. As a long-term investor, 30-year water bond infrastructure, maybe with a floating rate of return would be awesome for a pension plan to own, but they don't exist. Private equity, we know a lot of evidence on private equity in the Bay Area. That's been very popular. About 40% of all venture capital is being done in the Bay Area by Bay Area in the world. So plenty of we know there's good examples there. The Bay Area Council started a fund, thank you, 10 years ago. And they're winding it down now, but it was a top quartile equity fund here. I mean, you got Pandora and Tesla and Revolution Foods, and you got some great startup companies that are being focused on by double bottom line private equity investors in the Bay Area. So we know that can be done.
Yeah, but why are they winding it down?
Because they're 10 years old, 12 years old, and that's the life of the limited partnership. They started in '03.
The first fund?
The Bay Area Council, for their growth equity fund. So they've done very well. And I think there are new funds coming out that are predominantly Bay Area, not 100%. But those would work. If we had a portfolio, I know 3 private equity managers I would give money to today because of what they're doing. I've met some managers in the real estate area that I would give money to today because of what they're doing in the Bay Area, and it's green and it's healthy and things like that. So if someone gave me $150 million today, I actually have a model portfolio, and that's what we're going to be tracking and researching and blogging and sharing. So these are the things that the Bay Area mission,
Quick question on asset
investing in.
classes.
Yeah.
The only thing you haven't mentioned, I feel, is the opportunity that some of the researchers found is non-bank intermediaries, non-bank lenders, other than CDFIs, because by definition, CDFIs are lending into below market only. But there's a lot of businesses that get turned down from banks that need loans that could pay market or greater than market if managed properly in a non-bank financial intermediary that's doing debt. So like venture debt almost. You know, is there any research that you're finding or anybody that's talking about this space of?
I don't
venture
know, but
debt?
I would be happy to put that into our research mix and say it's another piece of the pie
Are you
that could
talking
be
about
considered.
Silicon Valley Bank, or are you talking about like Solar Mosaic?
I'm talking
Lending
about,
Club, SoFi?
not even that, I'm talking about 20 businesses walk into a bank, 1 get a loan, 19 walk out without. 2 of those businesses should get a loan, but because of the technicalities of the credit underwriting,
Yeah.
they're not getting loans. And they could qualify for a loan that is at a higher rate of return, and if you manage a diverse portfolio, you're making more than fixed income. So that's the intuition that a lot of the work we're doing is.
And if I'm a fiduciary, I need to have a good intermediary, presumably,
Exactly.
preferably a registered investment advisor, because I'm not going to do it. I'm a trustee. I'm not going to go researching
Yeah,
this
a
stuff,
fund.
that kind of thing. So this is what we need to create is the community of people who are specialists in one thing or another. Yeah.
So the key to Zip is doing that for smaller size loans, not the large enterprise loans, the small mom and pop stuff.
Yeah.
Right.
I think
Some
we got to be able to scale this stuff to be able to take
Yeah.
more money. But if people knew there was money ready to go, they'd create it. That's what Wall Street does, right? They would create the product, and that's what we're trying to do is determine what's the product need to look like to attract the kind of money that can flow through that makes the kind of impact that we'd like to make. So all those pieces should flow into this somewhere. And like in infrastructure, there's a tiny little firm that's taking units of $25,000 and they're putting solar on schools. And I think that's a great idea, but there's very little scale to it. What if I had $1 billion, so.
There's a vehicle for that. Business development companies, BDCs, they're publicly traded. They do specialize in senior loans to mid-market companies secured by assets, liens on assets. So the thing is, you'd have to structure it as a sustainable ESG matrix BDC. You could do it.
Well, if I'm a trustee, I need to put it in a fund, it would be in the fund of funds in some asset class, but yeah, that's the kind of impact that the impact report that would come out of this portfolio, would be able to highlight. But at this point, we don't have that yet, so what we're doing is saying, who wants this to happen? Let's all work together, to flow the money, make the changes, and do it under fiduciary standards. And I think that, that's neat. Okay, so I think we can do it. I think we know how to do it. I think finance knows how to do it. And ideally, I don't know who's going to own this. Is that going to be a nonprofit? Or is that going to be a family office? Or, what?
Public-private partnership?
Private partnership would be good. And all these different pieces, but what if you're that little old lady, and you got $250,000 and just say, I want to own a little bit of everything. Well, maybe we could make a note that's a fund of funds and, 5 asset classes or something in one piece of paper. Those are just, that becomes product development here, but I think that we can do this. It would help the Bay Area. I think they would be good investments. I think there is something special about the Bay Area. You know, the premium returns might be from ESG and our very clever optimization program, but it also might be there's just some magic sauce in the air here that we're more willing to take risks and have them be better because we're more productive here or something.
What's the next step for the initiative? You're trying to raise money, I assume.
Yeah, because we thought if we could get a McKinsey or somebody, you know, that really knows how to do market research and make it a formal study, there might be more evidence. There's been a lot of research out. So we're going to do it anyway. If we get some money, we'll do it better, but we're going to model the portfolios and keep speaking about this, and we'd love to have the public conversation get into the press. So more PR, more conversation, so that little old lady calls up her broker, you know, and says, I'm going to invest in the Bay Area, and he knows what she's talking about. Because right now, he doesn't, and she doesn't, and nothing exists.
Well, I think the timing's really good in San Mateo County. Our Heart Board has engaged a consultant and put $50,000 of their own money and prospectively quite a bit more into a feasibility study, because the hardest part of doing the affordable housing piece is actually not being taken care of by the TOA fund and others because their interest is too high. And so we're looking for the seed money to replace the RDA money. So they'll be calling you and anybody else on your team.
If I had the money, yeah.
And we'll be, so I think we do have the money to start doing the kind of
Okay.
research that you want to get done.
Awesome.
Yeah.
And we're ready to write grants, and just to continue to speak on it. Our website is up today, and Ronnie is tweeting as we speak.
And our website is BAII.org.
Aye.
And what's your Twitter handle?
What would be your fundraising goals for this next stage in terms of basic functionality and dream target? Just
50 to 100. Yeah, I think it's not that much in my mind,
Okay.
you know. But we haven't started asking until we've gotten some of this and the website up and things like that. So the May conference, where those blue books came out of, was the start kind of the concept. There were enough people that came out of that day who said, yes, I think this is something to carry forward. So we've now done more work, and we're at this stage now. We actually have an initiative. We have a fiscal sponsor who got us this space, and we thank you all for coming. You're going to see the caterers come in. We now have 20 minutes. We can hang out and talk informally, or I can just keep taking questions. But I should say our official program is finished. Thank you very much.